W opisie pod tym materiałem znajdziesz link do zbiórki zorganizowanej przez nas na rzecz pomocy Ukrainie. Chwała bohaterom. Ten epizod jest sponsorowany. Cześć, nazywam się Damian Jemioło, a to jest MamStartup Podcast. Posłuchasz tutaj rozmów z funderami, inwestorami i funduszami Venture Capital. Jeśli jesteś zaangażowany w świat startupów, koniecznie zaobserwuj nasz podcast na YouTube, Spotify, Apple Podcast lub Google Podcast. Zapraszam Cię do wysłuchania tego odcinka.
The first rule of venture debt is that it follows equity, it doesn't replace it. And you in Flashpoint, you do both. You do both equity and venture debt. I want you to begin with explaining to us what is the difference between the two and maybe why it should coexist, it should supplement each other.
As you rightly point out, Flashpoint does both. I'm on the venture debt side in Flashpoint. And I guess it's a first rule for a reason because, equity is expensive capital. Venture debt is a different type of capital. And so, it enhances venture capital. So as a practical example, if a company is raising a 10 million round, it can raise 10 million of venture capital, or it can raise 8 million of venture capital and 2 million of venture debt. It gives it the same runway, so it might have a valuation point in mind or a milestone that it's trying to reach, and that's what the money is for. But you get 20% less dilution if you include venture debt. And so, that's beneficial for angels, for founders. And this is why actually we're very close to the venture capital community and venture capital investors. And a lot of our leads, a lot of our sort of transactions originate from venture capital funds coming to us and saying, hey, there's a round. Do you guys want to, also augment it, enhance it with venture debt?
Let's just pretend that I founded a company. It's a platform that allows scientists and scholars from around the world connect and cooperate on scientific projects.
And is this a real company you founded?
I'm not going to say just yet. Maybe just imagination exercise. Maybe it's not. We'll get to that. Let's say that I think that venture debt could be a good solution for my company. What's so appealing about venture debt, and would my company qualify at all?
Well, it depends. I mean, there's a certain profile of company that we target, right? There's a few criteria that we look at for a company. I mean, the benefit of venture debt is what I said before. It's the fact that your equity is not diluted. You get a longer runway. So if you want to reach a next valuation point, you don't have to dilute the existing investors. But in terms of whether it qualifies, we'll look at a few things for a potential investment. Obviously, the founder. So we like to have a connection with the founder. It's a chemistry. We have to be obvious. This is the person that's going to take the company forward. So that's a key thing. Who are the venture capital investors? Who are the angels or venture capital investors that are already in the company and are coming into this round? Because for us, your example is still not profitable, right? It's going to spend money on marketing. It's going to grow. So we want to see that there's supportive investor base in it. That at the next round in a year or 18 months, people will follow on. So for us, it's important that the venture capital that's there is high quality. So, T1, T2, or whatever. That's a preference.
So if I'm not mistaken, you're looking at the investors that are in right now?
Or coming in
or coming in.
Us. Mm-hmm. Yeah. So it's who we have to live with, right? Then the company itself, we tend to not do seed rounds because what we'd like to see is product traction. And some of this is Flashpoint philosophy. So maybe other venture debt funds are slightly different. But we like to see product traction. So the fact that the market accepts your product, is willing to pay for it, you have revenue, history that shows growth, and that your revenue is at least, sort of 3 million, ARR. So this just shows to us that the product makes sense, right? These are the key things. There's a few other sort of, other things that we look for to sort of make the credit story more solid, and that's, for example, your cash runway. So venture debt is not kind of a bridge loan. It's not a loan of last resort. It's not a loan that you get if you run out of money and you just want a bit more time. We lend to a company that has, 12 months runway, for example. That's ideal for us. 12 months runway that we know for the next 12 months, it has enough cash to operate and reach its goals. Early stage, but usually it's sort of Series A. That's kind of where we would first start looking at it.
So is there a possibility that I do not have a venture capital behind me or neither angel investor, I'm just bootstrapping?
It's possible. It's just a higher risk for us. So, I mean, we look at each company on its own merits. For example, if your product is amazing and you have amazing traction, and maybe we can see that if you can be profitable very quickly, we could say, okay, we have confidence that this will happen. And so we kind of live with the fact that you don't have angels or VCs. But the normal course of development would be you have your idea, you kind of bootstrap it, then you have an angel round where you raise a few million or, $1 million or something. And then once you have a bit of history, you do sort of a Series A where you raise maybe 5 million. At that time, we would say, okay, that's where we come in. We would come in at that stage alongside the 5 million. Instead of 5, you'd raise 4, we would put in 1, for example. Or if you raise 8, we'd put in 2. So that's normally the path that the company takes, and that's the point where we come in.
So what I'm hearing from you is that, in fact, there are a lot of nuances that you are looking for, and not just the investment criteria that I found on your website. It's like you can make exceptions.
Of course. I mean, we're not like an automated sort of, you put in the code and then the money sort of comes out. It's much more nuanced than that. But what I've said, sort of these 3 or 4 points are probably the most critical. So again, product traction and revenue growth, revenue or ARR of at least 3 million, VCs, cash buffer. That's probably, and obviously the chemistry with the founder.
So help me understand how it works and why it works. Because, banks historically do not want to lend money to early stage companies, to high risk, fast growing startups, because it's very risky. So how you make it work?
It's an interesting topic. We see some banks trying to come into the space, and in some sort of mature markets, like in the US, you have Silicon Valley Bank, for example, that obviously is focusing on these sorts of companies. In Israel, banks are quite active in this space as well. So these are, I would say, as the market matures, banks come into the space more. But I would say traditionally, you're right, it's not a space where banks play. Banks tend to look for profitable companies. So they would look at the financials. I would say there's sort of 3 things that why banks don't necessarily look at venture debt. One is they're set up to look at profitable companies that they can analyze very quickly. They have revenue history. It doesn't have to be fast growing, but they have profitability history, and they'll lend against that cash flow. So for them, they get the accounts, look at it, it's easy, simple. These sort of companies are not like this. They're not profitable in most cases. So we need to understand the engine of the company, the unit economics of the company, to get a view that this is a good business, right? Also, the companies that we deal with, they're not audited. We wouldn't start auditing a company until it's, a few years old. And banks, again, are not, which means that we have to do a lot of kind of manual work to diligence the company, to understand its financials, to understand its business. Banks are not usually set up for this. They don't have a team of people that do this. They rely on audited accounts. So for a bank, you have a profitable company with an audited account. They then, they can make a decision in a day. That's easy for them. If it gets more complicated, they'd rather pass and focus on what they're kind of used to, right? And then the third point is just deal flow. Well, as I said before, we're quite closely aligned to the venture capital kind of community. We're part of venture capital community. Because we interact with venture capital funds and founders, we see a lot of transactions. And some of them we like, some of them we don't, but we see quite a lot of the market. Whereas a bank doesn't, because banks have never been part of VC, of that ecosystem. And so they don't see the transactions. It's harder for them to originate, deal flow. And this is a problem that we've seen when we've dealt with banks. So, for example, a bank in Eastern Europe might come to us, to Flashpoint, and say, hey guys, we want to do this product. We want to partner with you, right? So, you kind of have the knowledge, expertise, whatever. We have kind of the capital. We partner. And one of the things that they always want us to bring is pipeline, is deal flow. So they just don't have the capability to generate it. So this is, I think, why banks struggle. Over time, it changes. So again, as the size of the market and the ecosystem grows, more kind of deal flow becomes more available to banks, and they might set up teams. It might make more sense for them to set up a team that do this. And so you might see that grow over time. But in our region, so in Eastern Europe, Central Eastern Europe, it's still not common for banks to look at it.
You use this term, the engine of company, the engine of startup, and I loved it. Being fond of organization and core competencies and capabilities myself. What do you mean by that? The engine of the company.
I mean, in this case, I mean the unit economics of the company. So, what is your customer acquisition cost? What is your retention? What's your customer lifetime value? But you need to be able to calculate them and isolate them. And again, not every company necessarily comes with built-in knowledge of how to do this right. So often what we see is the company sort of does some tracking, but we need to really go through their information and their history to understand the unit economics. So the hard metrics, right? So for every dollar that they spend on acquiring a customer, what value does that customer bring over the 3 years or 5 years, right? But what's the retention? Are they doing it? Are they calculating it properly? That's what I call the engine, right? So if these metrics make sense, or they're sort of good, if the company is showing growth, so traction, that tells me that it's a company with potential, and all I need to do is market properly, and then the growth will continue, and then the profitability will come. But if the engine is not strong, so if the company makes $2 for every $1 it spends on acquiring a customer, which is not a very sort of high metric, it just means that it's vulnerable. It means that it's going to take a lot of time for it to get scale. Because aside from this metric has to cover then all its overheads and R&D and all the other costs. So it just means that it's a much longer journey for it to get to positive EBITDA, and it's more risky because it's more vulnerable to shocks.
Obviously, you are cooperating with different venture capitals via your company's portfolio. Do you see yourself cooperating with banks in some way? Maybe telling them how to do it properly, or maybe building some,
It's funny you say this. I mean, we do have conversations with banks. We've had conversations with at least 2 banks, maybe more even. And this is in the last 6 months, because I've joined Flashpoint in September.
Maybe they should want to operate through you in a way.
I mean, some of them are interested in partnering, yes, for the reasons I mentioned. So banks have cheaper capital than us, because they're funded through deposits. They are big institutions. They can raise money much cheaper than us. So they have lower cost of capital than us, right? They don't have the capability to assess, maybe even document deals, and they don't have the pipeline. So there is a potential to partner. So we've spoken to 2 banks, and we've tried to even do a couple of transactions with them. And in theory, it works. There's no reason why it doesn't work. It just hasn't happened yet.
Who's more interested, you or them?
I would say them.
Yeah, I think so too.
Because we haven't proactively gone out and tried to find a bank to partner with. We've been approached. From our perspective, it's an interesting combination, which we were happy to explore, and we have explored. And maybe we'll do something together with banks going forward.
So again, moving to entrepreneur's perspective, let's say that my company has a strong engine and I want to apply for venture debt. What steps do I have to take, to receive venture loan?
Well, I mean, you give us a call. You provide us with, sort of basic information on your company. So, financials for the last sort of couple of years. You provide us with kind of the metrics of the engine. And I mean, we can provide you with terms pretty quickly. Obviously we need to understand what the company does and who you are, and so we'll have a chat. But if you have the financials at hand and the kind of unit economics, it's very easy for us to make a proposal. So once we make a proposal, we sign a term sheet, which basically outlines the structure of the loan, what the loan would look like. And if you accept the term sheet, then we document it. We go into documentation. So we sign, we develop and sign legal documents.
I don't only want to know what disqualifies me, but I also want to know who's not really qualified for venture debt and why, in your experience. Well,
if I think about our pipeline and the reason why we passed on leads, it goes back to the sort of the 3 or 4 things I mentioned before. So the company might we really want the company to have at least 3 million of ARR. So a lot of companies are too small, in which case we say, okay, well, come back when you have this. Because we want a company which has some history. It's not, venture debt is a cheaper capital than equity. We're not like VC where we can sort of invest in 10 things and one of them might give us, it's a different risk profile. And so we want the company with history. So a lot of times we just pass because it's too small, and then later on the company might come back. Sometimes companies come to us because they need money. Like they've got some urgent need to raise money. And it's not really what we do. We're not like a bridge loan. We don't want to be the last capital in the company that, without us, in 2 months, in 2 months' time, we put the money in 2 months' time, the company will run out, right? We want to see, 12 months life in front of us. And so in some cases, for example, the company couldn't raise equity and then they come for venture debt. And we say, well, sorry, without equity, you can't have debt. It goes together. Unit economics. So I think most often we pass because of what I call, again, the engine. Like we can't get comfortable with the fact that the engine is strong, or it's sort of unclear. We also focus on I would say, a fairly specific kind of universe. We don't just do anything. We focus obviously on tech, obviously. We tend to prefer SaaS, but not necessarily. But we stay away from things like hardware, for example. Because hardware is it's an expensive development cycle. It takes a long time to get revenue. So we get some hardware, for example, companies coming to us that are pre-revenue. So okay, we don't do that. So these are, I guess, some of the reasons why we pass.
I asked you this question and I wanted to elaborate on it now because I found in a Polish venture debt market analysis that venture debt is really popular in life sciences, but not really in IT and software, which is exactly what you do.
Yeah.
Do you have anything?
It's interesting. I didn't know that.
Yeah. I mean, maybe it's a different perspective from someone who hasn't really analyzed the market that is non-existent in Poland, because venture debt is just, the market is just non-existent. It's starting to grow mostly because of you and Flashpoint, but do you know any venture debts, any other companies that do what you do, but in different industries, or they do prefer, I don't know, life sciences, for instance? You mentioned that you really don't do hardware.
We try to stay away from hardware. We've made an exception in our portfolio once, but I think generally venture debt is not that well known in the region, even outside. So aside from tech, but just more generally, like you said before, we had a chat before we started this. It's a well-known concept in the US because the ecosystem there is much more mature, and so over time it's become a big part of it. But I think in our region, amount of debt raised versus the amount of equity raised or venture capital raised, it's disproportionate, right? Like in the US, maybe you have like 15% of all capital that goes into the sort of tech startup space is venture debt. In our region, it might be 2% or 5%. It's I think generally it's just a function of the maturity of the market.
But do you find it gaining in popularity?
Yeah, for sure. Just comparing it again, I've joined Flashpoint in September last year, but from our team, the number of opportunities and also the level of knowledge about the product has really increased in the last sort of 2 years. And it varies by country in some way. And Poland sort of had a real, I think, boost in terms of its VC ecosystem in the last few years. So it's gone from kind of, call it 35 million per year to now like 800 million per year. So there's a huge jump. And as a result, we're doing venture debt now, and I'm sure others will start looking, and you'll see venture debt also follow that trend in Poland. In other countries, it's different. I mean, we can get onto this later, but because Europe is not sort of an entirely homogeneous kind of legal system, it's not as easy yet to sort of say, well, it works in Poland, therefore it's going to work in Czech Republic, or it's going to work in Austria or somewhere else. Like each country has its own nuances, particularly when it comes to venture debt, because venture capital is much easier to document. You can do a CLA or something, or SAFE. It's easy to document. Venture debt is a little bit tricky because it's secured. And so each country, whenever we do a deal for the first time in Poland or somewhere else, we have to do legal work to understand the nuances of the system here. How do we take security of the company's assets? How do we structure a warrant? How do we, are there any kind of restrictions on kind of our basic loan documents that we need to take into account? And so it's, whilst the concept is the same, you need to adjust the documentation from country to country, which makes it harder to really see, for somebody to come in and say, I'm just going to sort of do this in Europe. We're probably the first, and we've now got deals in several European countries and we've sort of tried to do deals in
Central and Eastern Europe.
Yeah, Central and Eastern Europe. So, but not just that. So, we've done deals with companies in Western Europe as well. So we know, I would say, most of the jurisdictions pretty well. And some of them are more friendly than others. Like Poland's quite good, actually.
That's funny because I'm going to get a list of wishes from you in a moment. What would you change? What would you wish would be different? But let's for a moment discuss what fosters this market growth, venture debt market growth and development specifically, which is success stories and companies that you invest in and lend money. Could you tell about some of the companies that you are backing?
Just to take a step back, I think what triggers the growth in the market. I mean, before you have a success story, you need to have kind of the journey that comes before. So I think in Poland, the government has done quite well in kind of fostering this ecosystem in providing funding to seed rounds through the national fund, and then sort of facilitating both Polish VCs but also external
public
VCs.
capital.
Yeah, exactly. Yeah. So I think that's really a big factor in this rise, and then that creates success.
So you find a market and companies that you are ready to lend money to.
Well, exactly, because let's say, so in Poland, because of this approach, you have more companies going from seed to Series A because the funding is there, right? And so for us, all of a sudden, there's a universe of companies that we can look at, because we can't look at seed rounds. It's too early for us, right? So all of a sudden, the number of companies that are raising Series A successfully in Poland is increasing. We see, non-Polish venture capital funds come into Poland. And that means that, as I said before, we'll look at the venture capital sort of backers of whatever we invest in. And we see that there's more, more firepower coming in there. So, okay, for us, it's great. And then this becomes like a virtuous cycle, where that success then encourages more people, and then the government funding is there. So this, I think, has been a real impressive success story in Poland, right? So in terms of kind of our I mean, OmniPack is the first the first venture debt.
So just to say, for people who don't know, OmniPack, the company that provides a full stack fulfillment service, right, and it has venture capital backing, SMOC Ventures for some who don't know, and now you. So.
Yeah, exactly. So that's the first investment we did in Poland. But we also looked at other Polish companies. There's quite a lot that are currently raising money in the market. There are a lot of success stories, like Uncapped, Booksy. So all of these is like we follow. Yeah, we follow exactly. We follow a lot of them, a lot of these companies, and not all of them we can get into. But
I'm very interested. Companies like, I don't know, Booksy or Dog Planner that are really enormous and gigantic. Are they even interested in talking to you and maybe?
So this sort of goes back to how we do things in Flashpoint, and why kind of Flashpoint is set up the way we're set up. And this might be, let me know if this is too long.
No, I think it's going to be perfect.
So the idea with Flashpoint is we like to, if it's a good company, like Booksy or OmniPack or Uncapped or whatever, we like to be able to follow its life cycle, right? So when it does its Series A, we have a venture capital fund that wants to put in. Let's say we miss out on Series A for whatever reason, right? Too competitive or something. We want to be able to.
You as Flashpoint Venture Capital.
As Flashpoint Venture Capital, the firm, right? So within Flashpoint Venture Capital, we have venture capital and we have venture debt and we have secondaries, right? So venture capital comes in at the earliest stage of the company's development. But if, for example, we love the company, but for whatever reason, we just miss out on a deal, venture debt can then come in at a slightly later stage into the same company that we know and love And then that's another opportunity for Flashpoint to deploy capital. If we can't do that, then the secondaries fund, which is again a later stage fund, can come into the company when it's sort of 5 years or 3 years pre-IPO. So we're looking at another Polish company with a secondaries fund, for example, at the moment. We want to be able to sort of fall in love with the company and its story and be there at multiple stages to support it. And venture debt is one of these stages. So when it comes to companies that have become unicorns like Dog Planner or even sort of that are on the way to becoming unicorns, I doubt that they might raise venture debt, but it's usually it might be in an amount that's too big for us, for example. But we do see companies that are revenue of 100 million still want to raise venture debt, right? So in some cases they do, but even if they don't, when we have the secondaries fund, for example, that will allow the founders to get liquidity at a stage before it's IPO'd, right? We try to track them along this path, and then we have different sort of pockets of capital to provide them with capital at different points that they need. So I think this is sort of maybe a unique feature of Flashpoint, because for us, if the company is great and you've done the work, maybe you've invested in it, it just de-risks the investment. We love to follow on. If we've lent to a company, the company is doing well, we'll lend again. We specifically want to deal with companies that we know and love throughout their lifetime.
Are there any synergies for companies that come from your Flashpoint Venture Capital backing as well as Flashpoint Venture Debt backing on different stages?
Sort of synergy is pipeline. We deal with the same universe of companies, and so we're kind of one team in that sense. So a company comes onto the market, venture capital will look at it. Okay, venture debt. What's the best sort of capital source for the company? Once it grows, we haven't done a deal yet together with our VC fund. So as venture debt, we haven't done a deal yet together with our VC fund, but it's not something that we could do, because again, it comes back to this point of, if we're in a company as a venture capital investor, we understand the company well, why not also give them debt? Assuming you can resolve kind of the corporate governance.
So it comes naturally.
Of course. Yeah. Like I said, we sort of there at different steps of the company's development.
So at a certain point, you can come up to a company and say, did you ever hear of venture debt? Maybe you'd be interested.
Yeah, of course.
Okay.
Of course.
Mm-hmm. In your opinion, which is the most venture debt market friendly region or state, except for United States?
Well, we're talking about Europe, right? I would say, I would sort of answer the opposite way. There are some places that are more difficult to do venture debt in, right? I think Poland is relatively easy from what we saw on OmniPack. So again, it was sort of my Donatella's deal, but we looked at deals in countries like Austria, for example, or Switzerland, that have, for example, in Austria, to provide secured debt, you need a banking license.
Okay.
So
in Switzerland, it's much more difficult than in Poland?
It's something different because, for example, to come back, whenever we give a loan, we take security. It's a secured loan. So we take security over the company's assets, and we get a warrant as well. So it's like a small equity upside for us. Taking security very much depends on the local laws and the legislation and how that's evolved. In the US, as you said, it's easy. You can take a fixed and floating charge, which means that's one document basically that says we just cover everything. And if there's new receivables, for example, coming in, automatically they're included in the security pool. So you don't have to, every time you have a new receivable, you have to get a new document. In some places, I think like Switzerland even, you can't do that. But the point is, if you want to take security in Switzerland, it's extremely kind of cumbersome and difficult from a legal standpoint to get the same protection. In Austria, as I said, you need a banking license to provide secured debt. It's got a very strong kind of banking lobby. So some venture debt funds structure around that. So I know that there are deals that have been done in Austria, like Zizu recently, and I think Refurbed last year. So that people have kind of structured around it, but it's an obvious obstacle. So, if I talk to my lawyers and we say, listen, we've got an Austrian deal, they'll be like, oh no. come on. So there are some sort of specific places where it's difficult. Where we've done deals, so Poland, UK, sort of thinking about other places, Finland. So these places are quite friendly. And I wouldn't say that from the others that we looked at, so other parts of Europe that we looked at, there's something that's particularly unfriendly that stands out. But we haven't yet covered all of it. It's like we haven't, for example, done a deal in the Czech Republic, so I can't tell you if it's sort of friendly or unfriendly. You know, like having a legal system that's been kind of evolved over time, like in the UK, obviously makes it much easier. You know, it's like the UK is very easy.
It's funny that you were more fond of discussing the more cumbersome countries and regions than the ones that are more, you know, legal-wise friendly markets. But apart from Europe, would you name a few countries that do it right for you? Like they do it right for companies, early stage companies that want to receive venture loan, and it's much easier to get to them.
The US is obvious example. Other than the US, to be honest, I don't know, because we really focus on Europe and Central Europe. Sure. I mean, Israel is quite a mature destination, so that's an obvious one. You know, the Baltic states and the Nordics are quite mature. So like I don't mention them because I think it's sort of, in some cases it's obvious that they work. But outside of Europe, I wouldn't know. We're not a global fund yet.
Now, a long list of wishes from you. So let's say that there is a room for growth of venture debt market in Poland, in Central and Eastern Europe. Your list of wishes, what do you wish would have to happen, or what kind of change would have to be made on state level, or maybe the mentality of companies and entrepreneurs? Like, you can put anything you want in that list.
Well, look, it's an interesting question. I mean, what I find is the mentality of entrepreneurs is actually relatively similar. So no matter who we talk to, like the mentality, the entrepreneurial kind of spirit that people have is international. Yeah, people want to start businesses, they have ideas. And, you know, tech especially, it's programming is an international language. So it's like it's a very similar, I think, approach. You know, again, using Poland as an example, I think you see what happens when you have kind of the right support from your government. The government, you know, it doesn't cost much, and it can really help kind of facilitate this ecosystem. As I said before, like the amount of venture capital funding that's been, you know, deployed to Poland, it's gone up from, you know, less than 50. It's gone up 10 times per year in the last 3 years, right? And so if you say, like, what wishes would I have for Poland, you know, 3, 4, 5 years ago to make this journey? It's some of it would be what you guys have already done. It's obviously, you know, bureaucracy for starting companies is you know, so again, going back to maybe the former Soviet bloc, some of those countries still have bureaucracy that it makes it really difficult for just to start companies and you know, like, so having a sort of a digital economy, if you will, is very helpful, because that helps the first step. Having sort of an ecosystem or a state that supports the earliest stages of the funding. So maybe there's a development bank or a development organization that says, I'm going to fund, you know, seed rounds, or I'm going to fund, you know, Series A. I think creates a grassroots level of confidence that, you know, I can actually do this. I can register my company, the funding is there, so I can see myself in 2 years building something, right? And that then, and the third one is, you know, facilitating, I would say, foreign investment as well. So again, it's not a problem in Poland, but it's a problem in other countries, you know, potentially becoming a much bigger problem in Russia as we speak, for example, right? So having, you know, global or even European VC funds look at the sector, it becomes big enough for them. There's enough of these grassroots companies that then creates this virtuous cycle that I mentioned before, where the companies then have Series A funding, and then, you know, other market participants come in. So this I think is like a good sort of a good recipe. I mean, the legal framework, I think, is for venture debt is much more important than for VC. But venture debt is like a turbocharger for venture capital. So if you've got a great ecosystem of venture capital, but the companies can't get debt. They can have to go to a bank, once they're much bigger. It does slow down the growth, right? So it lacks this turbocharge that we can bring to the ecosystem. So again, simplifying how you can take security over something, simplifying how you can formalize a warrant, for example, is very helpful, and not restricting funds like us from doing business like they have in some jurisdictions. So it's really sort of, removing bureaucracy, helping at the very early stage, and then having like a legal framework that is A, reliable, so we can be sure that it's enforced, and B, kind of simple, so that, we don't need to do 20 documents to take security over something.
Is there a room for you to educate or to lobby to help adjust these ecosystems, local ecosystems?
I mean, we do, and it's usually done through sort of specialist law firms in these countries. So, for example, we not just. I mean, we're obviously happy to speak to kind of Ministry of Development or Ministry of Finance of any country, but really there are law firms that specialize in this, and they're at the coalface of like what exactly needs to be kind of changed, right? And so we deal with them as well. The difficulty is, we're not a giant company. We're not kind of a Silicon Valley bank, so we don't have like a lobbying arm. We talk.
You have podcasters.
Yeah, exactly. We talk to you. We talk to market participants. We talk to sovereign wealth funds, and we try to sort of put this position across, saying.
And most of all, companies that can vouch for your backing. Okay, so to anyone who has listened to us and thought, "Oh my God, I do not have to dilute my equity. Venture debt is exactly for me." The easiest way to reach out to you and to contact you via LinkedIn, your website.
Everything works. You can go on the website. You can go into LinkedIn. That's got my contact details. So I would love to hear from anyone who is interested.